Welcome to this explainer. Finding a legacy industrial company that's actually pulling off a pivot toward futuristic, high margin end markets, it's honestly like finding a needle in a haystack. But today, we're looking at Standex International, ticker symbol SXI, and their Q3 2026 performance suggests they might just be doing exactly that. Let's dive right into the numbers. So, to really wrap our heads around this transformation, we have to ask, what exactly is fueling this sudden surge in top-line revenue? We're looking at an 8.1% year-over-year growth rate for the third quarter of fiscal 2026. Now, if you follow industrial manufacturing, you know that moving the needle by over 8% in a single year doesn't just happen by accident, right? It takes serious intent and some pretty aggressive positioning into brand new markets. And President and CEO David Dunbar hit the nail on the head recently. He pointed directly to, quote, year-on-year organic growth and strong operating performance. Basically, it's not just about buying up other companies to boost revenue, it's about actually growing from within. They've seen an 8% boost just from new products alone, and a massive 30% contribution coming from fast-growth markets. It's safe to say their R&D is absolutely hitting the mark. And Wall Street? Yeah, they've definitely noticed. This laser-focused execution has driven a strong buy consensus among analysts, with an average price target sitting all the way up at $290.80. That implies some seriously juicy upside from where the stock's been trading. It really looks like analysts are seeing the foundational changes Standex is making, and they are pricing in a very, very optimistic future. Okay, let's jump straight into Section 1, Q3 2026 Financial Highlights. Looking at the year-over-year comparison, Standex posted some really solid gains across its profitability profile. Net sales climbed up from $207.8 million in Q3 of 25 to $224.6 million in Q3 of 26. But even more impressive, they actually expanded their adjusted operating margin to 19.7%. So when you combine higher sales with better margins, you get a fantastic adjusted diluted earnings per share of $2.21. That's a really nice bump from the $1.95 we saw a year prior. And honestly, that jump to $224.6 million in revenue was absolutely no accident. What we're seeing here is a healthy 8.1% overall boost, heavily fueled by selling into fast growth markets. They're just flat out selling more stuff, and they're selling it into much better, much faster growing arenas. All right, moving right along to Section 2, Strategic Moves and Leadership. We're really seeing a super disciplined, dual-pronged approach from management here. On one hand, you have portfolio simplification. They recently divested Federal Industries for around $70 million, shedding a non-core asset to free up cash. Then, on the other hand, you have capital return. They just wrapped up a massive share repurchase program, retiring over 594,000 shares for just over $76 million. So they're aggressively returning value to shareholders while streamlining the whole shebang to focus on higher margin opportunities. Adding to all that structural momentum is a really interesting leadership shift. CFO Ademir Sarcevic has been promoted. He's expanding his remit to directly oversee the electronics segment as Executive Vice President and Group President. Now, this is a massive signal to the market. Management is literally taking one of their top executives and putting him directly in charge of the company's highest growth, highest margin division. Which brings us perfectly to Section 3, Electronics and Fast Growth. When you look at the sales mix, it becomes incredibly clear why Sarcevic's new role is such a big deal. The electronics segment now commands a dominant 53% of the company's total sales. We're talking about the undisputed profit engine of Standex right here, pulling in more than half the revenue while blowing the other segments, like engraving and hydraulics or aerospace and defense, completely out of the water. This segment is literally firing on all cylinders. They're posting 6.8% organic growth, and it's being driven by massive structural tailwinds. We're talking about the commercialization of space, modernizing the electrical grid, huge macro trends. Fast growth markets now make up over 30% of total company sales. And get this, they have a book-to-bill ratio of 1.14. That means for every dollar they ship out the door, they're getting $1.14 in new orders. Demand is actively accelerating. Let's wrap things up with Section 4, the analyst outlook. So right now, Standex commands a price-to-earnings or PE ratio of 31.1. Let's be real for a second. That is notably higher than its historical averages. Over the past decade, this stock has usually traded with a PE somewhere in the mid-teens. So a multiple of 31,
That tells us market expectations are sky high right now. Investors are willing to pay a hefty premium today because they are banking on some explosive earnings growth tomorrow. And here is exactly why they're willing to pay that premium. Analysts are forecasting a jaw-dropping 86.8% spike in earnings per share for this current fiscal year. They expect it to jump from $4.64 in FY 2025 all the way to $8.66 in FY 2026. And it doesn't stop there. It's projected to cross $10 a share by 2027. Look, when a company doubles its earnings power that fast, the market is more than happy to slap a premium multiple on it. With revenue projections marching steadily toward the billion-dollar mark, specifically targeting about $951 million by fiscal 2027, it's honestly no wonder Wall Street analysts are holding tight to their strong buy ratings. The lowest price target out there sits at $260, which is basically the current floor, while the most bullish targets reach up to $323. The consensus is pretty crystal clear. Wall Street thinks this transformation is a resounding success. But as we wrap up this explainer, here's the ultimate question you have to ask yourself. You've got an ongoing acquisition-heavy strategy trading at a premium 31 times earnings multiple. Yes, the margins are expanding and they are beautifully positioned for the new space in electrical economies. But perfection is kind of already priced in, right? So do the explosive rewards of this new and improved Standex outweigh the execution risks at its current market price? That is the billion-dollar question you'll have to decide. Thanks so much for joining me for this breakdown.